So here we are. We are at the last week in January and the end of the month. The market has had a very tough week. The Dow and the S&P are now negative. They've given up the entire month of January gains. And you have to look at the reason why. And there's this thing called the coronavirus, which I'm sure we've all heard about. But the problem is uncertainty. There's no clear idea or clear view on how bad it really is. We know it's bad, and we know it's in China, and we know it started in a very highly populated country, and it was transmitted from animals to humans. Beyond that, they say, oh, well, it's really hard like the flu on elderly and the young. But the problem is China is mostly elderly. They stopped having limited children about 20 years ago, so their demographic is kind of a barbell, really young, really old. So that's not really a good scenario for this coronavirus. And not only that, I mean, you look at the market was an all-time high. Everybody was probably looking for an excuse to see a correction. So I think it's a culmination of a bunch of things happening at the same time. But going forward, what's going to happen? I mean, fundamentally, the earnings are good, and we should not be having big problems. But by the same token, you look, were the good earnings already baked in? I mean, was the market frothy anyway? I think there's a possibility of some of that. So then we just have to look and say, okay, this is my opinion, I'm going to be defensive because I don't know what's going to happen, and if something happens, it's more likely going to be not good than good. So then I invest accordingly. So let's take a look and see, okay, what has happened, what's working and what's not. But before we do that, I want to bring this up, the arithmetic of losses. In an uncertain market like this, I mean, this thing it goes down a lot faster than it comes up. So you have to kind of draw the line in the sand, and I believe this firmly. There's a point where you say, okay, I'm going to really do something. I'm going to tap the brakes or really stomp on the brakes when the market or my portfolio gets down a certain percentage. So you can take a 10% loss because it only takes 11% to get back, but you don't want to. But that could be your line in the sand. Okay, 10%, I'm really going to do something, meaning you're going to lighten the load. You're going to look at stocks that do well in downturns and be more proactive. Because if this thing really gets out of hand and we're down 50%, you have to make 100% to get back to where you were. Now, that can throw a serious monkey wrench into your retirement plans, or if you're already retired, into, are you going to have enough money? So we don't even want to go there. So you have to figure out, okay, I'm going to do something. Going to cash is one possibility. Hedging is another possibility. But I'll show you what has been working in this market. And historically, what has worked in a serious downturn. So we'll get back to this, and we'll look and see, okay, what's happened? What's actually working? So let's look at mutual funds. This is a mutual fund that has a 0.5 beta, which means it should be down half as much as the market. And let's look at historical returns. We're going to look at 10 days because that's going to be probably the most relevant here. So this portfolio was down 2.1% in 10 days. How did the S&P, let's remember what the S&P did, and that would be in my benchmarks. The S&P was down 3.1% in 10 days. That's quite a bit. I mean, that's 5% is my action number. So 5%, if you hit 5% on the downside, it generally goes beyond that. but that's just a heads up. So then we're going to look at, say this is a total return portfolio. Let's look at current returns. It's got a beta of 0.3. It's still up for the year. It's got a dividend yield of 12.9, and historical returns, it's 10 days, it's down 1.9, which is considerably less than 3.1. And then we're going to look at a more recent, I built this portfolio, these are all client portfolios. I built this portfolio on 6/19 last year. Its 10-day return is minus 0.4, which is good. And in this market, it is good. And the current returns, it's still up 3%. It's got a 0.5 beta. It's got a dividend yield of 12%. So this is still relevant as far as this market because it really didn't go down very much. And here's 100,000. I build different sizes, and sometimes having more in the portfolio helps, and sometimes it doesn't. This is how I find out. So anyway, this one's down 2%. So the fact that there's more positions in this portfolio really didn't help out. I mean, it's more what you have than how many. And this has a 0.48, it's got a 12.3, and it's down a half a point, or half of 1%. So that's not bad. Now this is a very conservative portfolio. This is 60% bonds, 40% stocks. So current returns, historical returns, this is only down, 0.1, which is 1/10 of 1%. So this isn't appropriate for people who just don't want the drama. And this has a very low beta, so it is consistent with low beta investing, and it acts like low beta investing. It doesn't lose as much in downturns. This is a new portfolio I did at the very end of last year. Current rates, let's look at historical returns. It is down 0.6, which is good in this market. Current returns, it's up 1.9. It's got a beta of 0.39. It's got an 8% yield. So this has done much better than the market. And this is a monitor that I have different names for. But this was is a good portfolio. It was up 21% last year, has a 0.43 beta. And historical returns is down 0.8. So once again, the market's going to have to go down a lot before this one gets in too much trouble. So let's look at a low volatility. This is, I build these things to see, okay, how does this work? How's this going to work when the market gets really crazy? To have some ideas on what to do. This 10-day return is up. I mean, in this market, that's good. And current returns, it's up 2.5%. So even though it doesn't have a huge yield, it doesn't go down. And when not going down in this market is a good thing. And let's do 60% stocks and 40 bonds. So this is probably really well-known allocation. And this is down 1.3, which is still not bad compared to 3. So it is doing well. It's doing what it's supposed to do. But if the market really gets crazy, and it could, there's things you can do. And I said you draw the line, and then you act. This is such a portfolio. Current returns, it's up 2.1%. It's got a very low beta because it has a hedge, and it's called VXX, and this is a volatility hedge. So all you have to do to fix this portfolio in this kind of market is buy a position of VXX and walk away. And if the market keeps going down, you'll get returns very similar to this. This 10-day return is 1.9% positive. It's got a 9.1% dividend yield, which really isn't terribly affected by the VIX. So you still get your return, and you don't get all the market drama. Now, this is my portfolio. I made it January 1st. I had some money I wanted to invest, and I knew the market was not going to do well. So with that in mind, I tried to build a more bulletproof portfolio where current returns, it had a relatively low beta, it had a high dividend yield, and a year-to-date return is still beating the market handily, 5.2 positive. So historical returns, it's down 1.1%, which isn't bad. Now here's a portfolio that I retired in January. That the firm I work for, they said, okay, this is what we recommend, and they call this the active portfolio because it has all mutual funds, and it has a 0.88 beta, so you're not getting any relief in bad markets. And let's see if that pays out. Return is negative 3.6, so it tracks the market in losses. Likewise, this is their preferred passive. This is their idea of you have ETFs, and it is tracking not so good, and the beta is 0.95, so you would expect this to go down a lot in a down market, and it did not disappoint. So here is what I've done. I've drawn my line in the sand when we start bumping 5%. I took out one of the positions, it was IEP, and added in VXX. So I made that a full position in this portfolio. So if you had $1,000, you would put $200 positions on each one of these. And that would be, you would get a 12.8% return. You would have a beta of 0.3. In this market, it's up 4.1% in 10 days. So this is what you want and how you want to invest in markets like this, where if you ideally just hope it stays flat and you're going to get a 12.8% yield, then you walk down, you're happy. I mean, you're going to make 12%. So this is how you invest in this type of market, and it worked because I've been using this type of investing since 2009 when I kind of invented it. I had a bunch of clients that were retired. The market was just going down every single day, and I had to protect their money and then also give them some income. So this is how I did it. It worked. It's worked ever since then, and it's a very good way to go. Then just last week we did an exercise of an account that pays you monthly, and these were like the raw materials what we used to make it. And this is the monthly portfolio. This is 5 positions. There's no hedge. There's no anything. It throws a dividend yield of 8.3%. But it has a very low beta, and that beta was built into this portfolio. I mean, we had a low beta on purpose. So it was up 0.12 Friday, and historical returns, it's up 0.4 in this horrible market. So this you don't have to do any crazy things, but it's got an inherently low beta, and low betas, as you can see, works in this market, and this is how you can make money and not lose money in uncertain times, which I think was a classic definition of where we are now. And this is another one. This is a quarterly pay, so this was down some. In historical returns, it's down 0.1. So that's not bad, but if you can get a monthly pay, I mean, this portfolio throws out monthly, and each figure you get a paycheck from each one of these a month, you would get 60 paychecks a year in cash flow, and it would be 8.3%. I mean, you do the math, it works. So it's probably going to be more of the same. I wouldn't be a bit surprised if it gets worse, because I don't think we figured out how bad and what the consequences are of this. So be defensive. One of the guys that I follow, who I consider a genius, has gone totally defensive, and he's good enough to where if I was in the middle of the Kalahari Desert and he says it's going to rain, I'd be looking for my umbrella. He has gone from positive to full-on defense, which means for me, I would be sitting in my hedge position and getting the yield. And beyond that, I hope it doesn't happen. We'll see. So here's hoping for a better week next week, but I don't know. Talk to you later. Thank you for watching.